Hey, good afternoon, everyone. Marty Missouri here, Tuesday, 9/20/2022, with a quick market snapshot for you, but we're going to delve into the credit markets, the fixed income markets first. I'm coming to you a day earlier than usual. Usually I do a midweek update on Wednesday. I may still do something tomorrow afternoon after the Fed decision and press conference. But I thought because of that meeting, I want to talk a little bit about what we're thinking about with regard to the Fed and the challenges in front of them. And then I'll update the S&P 500 charts. We'll just do it live together here at the end. And I think I can do this relatively quickly. The point I want to make, though, first is with regard to the credit market. We talk a lot about equities, certainly when we do these market snapshots. It's for months now, it's pretty much just been the S&P. On occasion, we'll get into commodities and the dollar and other things as well. But we really don't talk a lot about credit. And when we think about this notion that the Fed is going to continue to tighten till they break something, it's really probably the credit markets that the Fed are most focused on, right? That's where liquidity happens. That's where financing happens. That's what makes the economy, the US economy, the world economy chug along, right? So there are indicators that we track every week that fit into what we call our PWA Financial Stress Index that we monitor and track. And I thought I might show you the look of a handful of those and talk about how serious they look relative to history and what they portend for Fed policy going forward. Because the Fed's talking really tough, right? We're gonna beat inflation, and virtually they're saying now, or at least Fed at Jackson or Powell at Jackson Hole is saying, even if it creates a recession. Well, we'll see. I want to start with the U.S. Treasury Liquidity Index. And I'll read from the label. The index is a measure of prevailing liquidity conditions in the U.S. Treasury market. This index displays the average yield error across the universe of U.S. Treasury notes and bonds with remaining maturity of 1 year or greater based off the intraday Bloomberg relative value curve fitter. When liquidity conditions are favorable, the average yield errors are small, as any dislocations from fair value are normalized with a short time frame. Under stressed liquidity conditions, dislocations from fair value implied by the curve fitter can remain persistent, resulting in large average yield errors. And here is the look of that Treasury Liquidity Index currently, right? Here was the look reading into that very quick recession in 2020. And here was the look going back. This is as far back as we can go on this index. It was accelerating going into the great financial crisis of 2008. So this would denote stress or lack of liquidity within the context of the Treasury market. The MOVE index works with the weighted index of normalized implied volatility on 1 month Treasury options. It's considered the Treasury Volatility Index, kind of the VIX for Treasury bonds. And again, look where it sits today and what it's been doing the last year to two relative to what it looks like going into the 2008 financial disaster, right? The early 2000s recession, the 1990 recession, and so forth. And as you can see, it's been a harbinger of not good things historically. CDS spreads, and this is on 5-year investment grade corporate debt. Now, CDS, credit default swaps, are basically insurance policies against default on debt. And I must not be able to take this one back far enough. But CDS was a huge issue, a huge element in the 2008 financial crisis. We can go back and maybe I'll look when I have time and post links to past articles that I wrote all around that time explaining how CDS works. We were even doing YouTube videos back then explaining how that works and trying to help people understand and put into context what was actually going on at the time. And we've had CDS spreads kind of blow out a bit or ramp up. 2015-16, we had market stress. It was a 16% correction in the S&P 500. We had Q4 2018. I remember the Fed was tightening policy at the time. We had the trade war going on hot and heavy, and we had the market drop about 20% in the fourth quarter. Well, you can see what the CDS spreads were showing us there as well. They were showing a tremendous amount of stress. And folks, look at them here today. These are concerning levels, and this is the market bidding up the risk that corporate bonds could go into default. So that paints a very not rosy picture about financial stress in the overall system. The JP Morgan Foreign Exchange Volatility Index, okay, the name kind of speaks for itself. Here we were going into 2008. Here we were going into that, that period where we had some inflation concerns, et cetera, right in here. Had the European debt crisis right in here. That was about a 20% decline in stocks. And here we are today. The high yield credit spread. This is on 10-year junk bonds versus 10-year treasuries. Okay, so when the yield differential spikes, that tells you that risk of default is rising and it's being expressed in the junk bond market. Not, not epically high, not, panicky, but certainly elevated, make no bones about it. And the trajectory is quite steep, telling us that, credit risk out there is rising. And then lastly, let's just look at the long-term trajectory of 10-year yields, right? This goes back all the way to 1982, and this has been just an amazing trend line. This is interest rates on the 10-year Treasury. Here we broke through that downtrend line and then tested it successfully, and now we're sitting at multi-year highs on the 10-year Treasury. Now think about that within the context of course, mortgage rates, which are over 6% right now on average. Think about it in the context of the trillions of dollars that are in pension plans. The stress on the pension system goes up as well. So if you're on the Federal Reserve Board and you understand all these things, well, you need to talk tough against inflation. You need to get expectations down. You need to get inflation to whatever degree you can control that, and that's a big question mark there in terms of the degree to which they can, given the nature of present inflation. You've got some huge concerns, and then you can talk tough, and you need to talk tough. But at the end of the day, are you really going to aggressively go out there and break something? I don't know. I think we should be skeptical at this point, particularly if indeed we see inflation coming off the boil. And folks, don't forget, we have we think a very solid thesis that suggests for a variety of reasons, big evolutionary reasons, we're going to see consistently higher inflation than we've gotten used to the last 40 years going forward. And that has implications on how we're going to allocate assets and so on and so forth. Right here, right now, however, we can see some real building stress in the credit markets that we think is going to have the Fed thinking twice about just continuing to jack up rates to the point that the bearers who trade equities are suggesting that they're going to. So we'll see. They may indeed break something. Something may indeed begin to break. How much further can they go? I think that if we start seeing data roll over, as I suggested this morning, and I don't know that they're not going to talk really tough tomorrow and do a real number on markets like he did at the Jackson Hole meeting. That may very well happen. That may be the plan. But beyond that, I think we should be skeptical in terms of how far they're willing to go and how much pain they're willing to exact upon the markets and upon citizens, so to speak. Okay, so quickly now. Literally just going to do this as we go. So here's the hourly chart on the S&P 500. Folks, we continue in what we would call a falling wedge, that pattern that just keeps failing right here. Remember what I keep saying. In a bear market, these patterns will fail more often than otherwise. But my oh my, we still have, at least on the hourly chart, quite the bullish setup, right? We've got just very defined bullish divergences, a real downward wedge. People are trying to draw bear flags here. That just is not a bear flag. It's just the size, the shape of the flag and everything just doesn't fit. But clearly it is a downward sloping wedge, which is actually bullish. So again, I think tomorrow is going to be key, obviously on a short-term basis. And you can forget this. If they raise 100 basis points and talk tough, the market's going to crash through that like it wasn't there. Okay. But otherwise, if you didn't have the Fed meeting looming and so forth, and you're a short-term trader, you'd be going aggressively long right here based on that hourly chart, short term. The daily 1-year daily. We'll probably just stop with this one today. We actually do have here kind of the same, very similar pattern, right? Actually do this. You have your wedge. You might get away with the bear flag here. Okay, so there's two things going on here. I think you could legitimately call that a bear flag, and if you could, and you're trading that, we've got a bit more pain. Doesn't take us, takes us down pretty close to that June low. If we break down tomorrow, that's going to look pretty technically valid right there. And while you do not have a bullish divergence on the MACD, you certainly do on the RSI. So again, short term, the technical setup is for if the Fed comes off the least bit dovish tomorrow, it'll be 0.75 in terms of the Fed funds rate increase. And a lot of talk about the disinflationary data that's been coming out of late. That'll probably have markets feeling pretty good tomorrow. 100 basis points, right? 1% rate hike with tough talk, as I'm just basically repeating myself now. Couldn't imagine it not sending the market lower and crashing through some levels. And at some point in the not too distant future, with that sort of Fed backdrop, we're going to get close to our downside target and start getting somewhat bullish for the go forward. So, folks, longer than anticipated, but I'll leave it there. Hope that was instructive. Wanted to give you that kind of that credit market backdrop before tomorrow's meeting. Talk at you again very soon. Hope you have a great rest of the day. Bye-bye.